Hey there, welcome. This is another in the 10-minute tip series of recorded programs for credit and collection pros. This one is titled What Credit Professionals Should Know About GAAP and IFRS Accounting Rules. My name is Michael Dennis. I'm the presenter today. Let's go ahead and jump in. By way of introduction, publicly traded companies around the world are required to follow specific accounting rules, policies, and procedures. In America, in the US, accounting rules are called generally accepted accounting principles, and publicly traded companies are required to follow generally accepted accounting principles. Elsewhere around the world, and more specifically in 144 countries and counting, the rules that apply are called the International Financial Reporting Standards. IFRS is the acronym. So if you are a US-based creditor company doing business with foreign customers, or for that matter, if you work for a multinational company, then you probably need to know about IFRS and GAAP accounting and potentially about some of the differences. The US has not adopted IFRS standards. There have been discussions about doing so. They've been ongoing for probably decades at this point, and there's no indication that at any point in the near future will the US adopt the IFRS standard for accounting. To reiterate, US publicly traded companies follow GAAP, the generally accepted accounting principles. GAAP is considered to be a rules-based approach to providing guidance to accountants and their employers about their day-to-day activities and about how financial statements are to be prepared and presented. GAAP rules are said to be prescriptive, and GAAP rules are backed by legal authority. GAAP provides specific rules and procedures for accountants and companies to follow, and those rules and procedures provide little room for interpretation. And in addition, the GAAP accounting rules require more disclosures by publicly traded companies than the rules that are promulgated by the IFRS. Turning now to the IFRS. The IFRS is considered to offer interested parties such as accountants and their employers, corporations, companies, etc., a principles-based approach to the accounting process. As such, IFRS rules are more flexible than GAAP accounting rules. More specifically, the IFRS offers general guidelines that accountants and companies are told to interpret to the best of their ability. And IFRS accounting rules require publicly traded companies make fewer disclosures than those required under GAAP accounting rules. Here are a few of the more notable financial reporting requirement changes or differences between GAAP and IFRS. For example, GAAP accounting rules require that publicly traded companies provide 3 years of income statement related information in their publications. The IFRS requires only 2 years of income statement information. Under GAAP accounting rules, current assets are listed before non-current assets on the balance sheet. Under IFRS, on the balance sheet, non-current assets are identified listed before current assets. And as it relates to the statement of cash flows, the cash flow statement, GAAP accounting rules require that publicly traded companies provide 3 years of cash flow statements, and the IFRS rules require only 2 years of cash flow statement be provided to interested third parties. Financial reports continued. Under GAAP accounting rules, publicly traded companies, when they publish their quarterly or annual reports, are required to include a section titled Management Discussion and Analysis. So that is a monthly and annual requirement. Under IFRS rules, the MD&A section need only be included with that publicly traded company's annual report, not on quarterly reports. To continue to highlight some of the big differences between GAAP and IFRS, here is a discussion of inventory rules. Under GAAP accounting, inventory can be reported based on last in, first out, or weighted average cost methodologies. Under the IFRS rules, companies cannot use last in, first out. That method is not permitted for valuing inventory. Under the IFRS rules, inventory is recorded at the lower of cost or net realizable value. Net realizable value. Under GAAP accounting rules, inventory is identified at the lower of cost or net asset value. The distinction is that the terms net asset value under GAAP and net realizable value under IFRS mean different things. Therefore, the results will be different since the intent is different and the definition of those two terms are different. Continuing to identify and highlight differences, I want to talk about fixed assets as they appear on the balance sheet. Under GAAP accounting rules for publicly traded companies, fixed assets must be recorded at their acquisition cost minus accumulated depreciation and/or minus any impairment charges. Under IFRS accounting rules, publicly traded companies list their fixed assets at their historical cost minus accumulated depreciation. However, under IFRS rules, the book value of fixed assets can be increased from time to time to reflect an increase in their current fair market value. Continuing to highlight the differences under GAAP accounting rules, there's a distinction made in financial reporting between operating leases and finance leases, or financial leases, sometimes called capital leases. The IFRS rules make no differentiation between an operating lease and a finance or financial lease, meaning that all leases are treated under IFRS rules as financial leases. Treatment of research and development related expenditures. Under GAAP accounting rules, R&D expenditures are expensed with relatively few exceptions. Under IFRS rules, research costs are expensed, but development related costs can be capitalized over a number of years. What you should know as a credit pro about the differences between GAAP and IFRS. Are there differences? Clearly there are. There are different accounting rules, different treatments of different items, different reporting requirements in terms of how many years information is going to be presented. But there are far more similarities than there are differences between GAAP and IFRS-based financial statements that we get from our customers. And for example, publicly traded companies under GAAP and IFRS both generate and publish annual reports. And the balance sheet, the income statement, the statement of cash flows that we receive, whether it is a publicly traded company governed by GAAP or a publicly traded company governed by IFRS accounting rules, are substantially similar. And because they're substantially similar, we can do substantially similar reviews. We can do ratio analysis, we can do trend analysis, we can extract valuable information in order to make better informed credit decisions. Well, if you made it this far, thanks very much. Thanks. I hope you found this program to be interesting. If you'd like to listen to the entire on-demand program or any of the other programs in the on-demand library, please contact my sponsor, Wisconsin Credit Association, for more information about that process. Again, thanks for your time. Have a great day. Bye, everybody.